The businesses built to help companies grow are actually failing them. That was the York take. Kyle, what did you mean by that?
Listen, I think fundamentally the venture capital industry that's been around for 40 years has gotten kind of almost too big to fail in and of itself, right? If you think about the mantra of 9 of 10 startups fail, how is that good for the entrepreneur, the founder, the economy, if the client of a venture capital firm is their limited partners and their investors and not necessarily the companies and the people that they're backing?
Caro, on the last 7 days of programs, every venture capitalist that's been on the show had a different strategy, right? In Vinod Costa's case, he went into his own pockets and made loans to portfolio companies out of his own funds, not the firm's funds. Everyone did it differently.
Yeah, we had, of course, the Founders Fund joined us last week after many had said, well, maybe they had antagonized some of the concerns, particularly in social media, by the media finding out that they were advising their portfolio companies to pull money. Kyle, what did you do in this situation for those portfolio companies that had money in SVB?
Well, listen, if you're an operator, every single day is hard. And if you have lived through the last few years of COVID and the global pandemic, and now the banking crisis that we're dealing with in technology and startups, you really just need a warm blanket around you, and you need a helping hand, and you need to triage and go into triage mode. This is wartime for startups. They need to know that they have investors and they have advisors and they have people around them that can help them figure out what to do during these times. Thankfully, a lot of our companies that are very, very early stage, a lot of them have multiple banking relationships. So whether that be their local or regional banks, married with a Silicon Valley bank or a First Republic or a Chase Bank, had some diversity. So it enabled them to move funds thoughtfully and collaboratively during the process. And, we just kind of warned our founders, even though it was real nice ending to a movie in the Titanic when the gentlemen are playing the violin on the end of the ship, there really was no reward necessarily to be that musician on that ship. So it was just be very thoughtful and pragmatic. And I think it's going to fundamentally shift how companies manage money moving forward.
What about managing business? Did you, Carl, have to think, okay, who are our winners here? Who do we choose to back, to offer support to? Or could you do it for all?
Well, I think at the end of the day, the way our model works, we invest in B2B software, so recurring revenue subscription businesses. Again, we're really, really early stage, and we're always, unfortunately, needing to bucket companies into different categories. You have your high flyers, you have your stable growers, you have the ones that are struggling. But at this point in time, to be honest with you, it was such the throes of war, and you need to just react and sort of support everyone. On the back side of it, though, Caroline and Ed, we're definitely focused on what to do now, right? The funding markets over the last couple of years, you've seen valuations constrain. You've seen later stage markets, of course, the IPO market, public tech market come down. This is only good for B2B software because there's no denying that more and more applications are moving to the cloud and more automation and AI is needed. But, how long is it going to take for it to settle? The market needed a correction, though, right? I mean, the multiples were far too great. Companies doing $1 million of revenue are being valued at over $100 million. That was just not sustainable, and you can't play power law that long with these startup founders.
Well, Ed, I mean, the only area that people seem to feel that they do want to write checks at the moment, maybe rippling aside, is artificial intelligence, right? And I wonder if the checks get smaller or larger, and as we could think about that.
Yeah, I think you're just going to see valuations that are more sane, right? I mean, I think we all know what a good company should be valued at, whether in the public markets or the private markets. And there's just been so many tailwinds the last several years that have made those valuations skyrocket. Companies, investors want to invest in good, sustainable, long-term businesses. This has always been the fundamental approach of York IE. I think you're just going to see a lot more pragmatism come to the market, which in the end, I actually think is going to be a good thing for entrepreneurs everywhere.
Kyle, there were big themes and ideas for 2023 that we were discussing even as recently as the night before SVB's collapse, right? About the idea of probably fewer checks being written, the sizes of checks at the start of this year being different to what they were in 2022 and 2021. You're doing 12 to 20 deals a year, seed stage up. What is business like for you this year? What kind of transactions will you be doing and at what cadence?
It's honestly never been better for us. Again, we are very early stage. It's one nice thing to be a newer fund where we have actual capital constraints to how much capital we can deploy per year. Think about how large the largest funds in the world have gotten. Think about how large the funding rounds for those companies that they're investing in are and how big their checks need to be to deploy $1 billion, $2 billion. That's kind of played its way into this market problem where so much capital needed to be deployed and that the valuation sensitivity and the pragmatism around the business fundamentals mattered a little less. For us, we're kind of staying the course in this early stage, seed stage. There's more and more industries now ripe for disruption, including banking, that we're going to look at a lot of vertical applications and different things that we think have a lot of momentum out of the backs of COVID, the pandemic, digital health, banking, asset management, those types of things.